Welcome back to another issue, another version of Macro Matters podcast here. My name is Rich Excell, and once again, I'm joined by co-hosts Tony Zhang and Blaine Reed. Blaine and Tony, thanks for joining us here.
Yeah, definitely, Rich and Blaine. Very nice to actually come back at the end of the summer and a lot of hot topics to discuss. Looking forward to it.
Absolutely. Good to see you, Tony. Good to see you as Rich as well. Thanks.
Lots to talk about for sure. As you say, well, we're here recording on October 3rd, start of Q4, if you will, right? And we've had a very strong year, and I think the stats are that when we're positive through September, 80% of the time Q4 is positive, and when September itself is positive as well, that means 90% of the time Q4 is positive. We know there's that kind of behavioral bias in up markets that people will want to kind of lean into that, and maybe what we're seeing right now out in the markets is giving them ammunition to do that. But I think maybe we can start by talking about interest rates. We've been talking about the Fed and central bank interest rates quite a bit. We were talking about that just before. It's been a little bit, so we've had some rate cuts priced out and then priced back in based on some data, some Fed speakers, whether we had the hawks out first or the doves out first, et cetera. But it looks to me like we're still kind of right just under two more cuts for the end of the year, and another 3.5 cuts if we go out into June of next year, and that's still, the market is still much more dovish than what's on the Fed dot plots, which don't have quite as many cuts out there. So maybe I'll start with you, Blaine, because you were a hater on rate cuts like I was. Tony was right, so we'll let him get the last word. But when you see what's going on in the markets, what are your kind of initial thoughts? I mean, the rate cuts seem to be inevitable at this point. So how do you think about maybe wanting to set up a portfolio for Q4?
Yeah, so I think great point to start here. I think we're going to get the 25 basis points in October. I am anticipating that we're going to get the talk about whether or not we're going to get 50. If we continue to get some of the, I think, jobs numbers that we got, say, like earlier in the week, I think that drumbeat is gonna pick up again, and I think the markets. Good news is, or bad news is good news, I guess, maybe for equities, in that if the Fed feels like it needs to lower rates, that gives the impetus for equities to march higher. I think that might be a little bit about what's happening in equities. But yeah, I think that's at least 2 for this year, and I can see there's going to be an argument for a total of 3. At least some folks making that argument. So I think that's going to be interesting to watch.
Yeah, for sure. And I think everyone knows my disdain for the non-farm payroll numbers, and thankfully, like old Yeller, they took it out back and shot it. It looks like, I think that's a number that didn't come out today, and I'm really glad. But to your point, Glenn, we don't need it, right? Because we've got lots of other labor data that's come out this week. Yeah. And the picture is one that's generally weakening, but it's not falling off a cliff. And actually there were some green shoots in some of that number, right? So the ISM number, the ADP, ISM employment number, the ADP numbers were definitely still showing a weakening trend. Jobless claims a little bit more mixed. If you look at the continuing versus initial claims, which usually leads the unemployment rate, that's still kind of suggesting that unemployment rates might tick higher. So again, along those lines of that weakening labor market. But there were some other green shoots out there that we saw, in particular, like if you look at the Challenger layoffs versus hires survey, that suggested that hires were actually picking up a little bit, kind of in that no fire, no hire market. So it might be weakening a little bit, but it's not falling off a cliff by any stretch. And then the small businesses, the NFIB survey for hiring plans actually ticked higher, and showing that maybe there's some hope for small caps out there. So it's not necessarily a labor market it's clearly weakening, but it's not screaming weak. And so maybe it's a Goldilocks type of environment where it's enough reason for them to cut rates, but it's not so bad that stocks have to sell off. But But Tony, you've been the one calling for more rate cuts. I'm sure you're going to be calling for more. You're probably really you're positioned for that. So when you saw that data this week, I'm sure it gives you some confidence that you get the right position in rates. But how do you think that there's a lot of people that are already thinking that way, and or is there still more to go in terms of what the assets that would respond in kind?
Yeah, Rich. I'm actually one of the folks that in Blaine's reference just now, who actually continued to insist that we should actually have a more rate cut. And Richie pointed out a very nice point. So we actually didn't see the hiring number actually falling off the cliff. But we actually started to see that the layoff, the unemployment number start to pick up to a certain extent. And that's actually not a big surprise. And that's what we continue to emphasize since the beginning of this year, that we continue to emphasize the dual impact of the AI adoption. And as more of the dual impact, one is augmentation impact, the other is replacement impact. Augmentation really refer to the company or employee taking leveraging the AI would actually enhance the productivity and simultaneously enhance the revenue generation for corporate perspective. That's one side. The other is replacement, that basically saying that company will be able to hire less and less of employee and simultaneously reduce the number of employee who can be replaced by the AI adoption, while simultaneously remain the same output or revenue generation. And one great example, like for doing it extraordinarily well, is Meta. Okay, so this is one type of company, and the other type of company, we don't want to talk about the bad thing, but here we show the dual impact. As this kind of a trend continue going higher and higher, we'll see that the structure actually change, the requirement, the demanding for different type of the employee. So we might continue to see the unemployment rate start to continue to pick up, and even though the total hiring might actually remain the same or maybe going down a little bit, if we actually look at the total number of hire versus the total number of unemployment rate, that actual ratio did not actually change like too much. It still remained to be well balanced, jittering around one. Simultaneously, we see the GDP number remain to be super strong, and even though Rich and Blaine, you too had the huge concern about the thickness of the inflation, which I agree to a certain extent. But here when we actually looking at this, like I'm more concerned about the deflationary impact of the AI adoption here. So if we actually offset the two sides, I continue to support or in favor of Federal Reserve taking the preemptive cut like attitude as what they did in September last year. Even in the September last year, they can do the preemptive cut. At the moment now here, I think they have an even stronger position to take a preemptive cut. So as what we look at the dot plots showed here, we might actually see 3 rate cuts, and if they can actually do it early, the earlier the better. If like a 25 basis point is almost certain in October, if they can do the 50 basis point, I think that's going to help to lift the U.S. economy and help the employment data to remain strong, simultaneously helping the stock market. So that's actually what's actually playing out. But there's a lot of factors like behind that. I think that we can continue to discuss along the way.
For sure, and I don't know if you saw it, but there was an opinion piece on Bloomberg today from Bill Dudley, who former vice chairman of the Fed. Now he's at some private equity firm. I'm sure he used to be at Goldman. But his point was that he doesn't think they should hike at all, or sorry, doesn't think they should cut at all, and that he argues that. And one of the points that they say is preemptive, as you said, risk management or preemptive, as you talked about, Tony. But the other is that the Fed is actually further away from their inflation target than they are their jobs target. And so from that standpoint, from a risk assessment, risk management standpoint, there, the risks aren't balanced. In his opinion, they're actually still more tilted towards inflation than jobs. And I know you've been rightfully talking to the point of the potential deflation from AI. But one would say that if AI plays out the way everyone anticipates, we should be seeing more productivity, which would potentially lead to more labor weakness. But we still don't see the productivity in the data. Where's the productivity that we see a lot of spending on AI, but we don't see any productivity. So where is that? Do I have to go and ask Grok where the labor productivity is going to come from?
Well, yes, very good question. I mean, where did productivity go right now so far? I think there was a report a survey to show, right, more than actually 90% of the investment into AI was negative or even not in a good shape. But here, if we actually look at the earning report and earning announcements like reported in the Q3 or Q2. We have already seen the company, Meta, as one example, the other company that continue to actually leverage AI to boost the revenue growth. And this actually we have already seen that like adopt huge like a productivity enhancement in the big cap. Magnificent seven names, and as we actually get into the end of the Q3, so some of the service companies, SaaS company, those company we will actually watch the earning announcement very closely to see whether there might be some ripple effect then help the mid-sized company or service company would generate a higher like a revenue, which AKA the productivity enhancement, while actually having significant amount of employee layoff. So this is what we should actually focus on. I think the investment community is really eyeing on the coming up earning announcements. Yeah, so all we should talk about that.
Yeah, I mean, you're making the case. It sounds to me like a bifurcated stock market, the same way we have a bifurcated economy where the rich get richer and the poor get poorer. And we've seen that with the wealthy who own stocks and houses are doing well. Everyone else is struggling. And the large cap tech names that are already generating a lot of cash flow are generating more cash flow, and everyone else is still struggling to figure out how to use it. But I wanted to talk about something else, because one thing we do see with the rate cuts, with the higher stock prices, with tighter credit spreads, et cetera, is that financial conditions are getting easier, right? On this chart here, I have both the Bloomberg Financial Conditions Index as well as the Chicago Fed National Financial Conditions Index, and I've got both other time series up there. I've got the average rate that they've been at for the last 15 years, and both of them are much easier than they have been on average for the last 15 years. And so I think it's hard to argue that rates are holding back the economy, because conditions are about as easy as they've been at just about any period. But even in that backdrop, Blaine, we were talking beforehand, we've seen some pretty high profile credit events. We've seen the Tricolor credit event that's hit some banks, right? And maybe there was a little bit of I don't know if there was a little bit of fraud or not, but certainly the banks have taken a hit on that one, and subprime auto, et cetera. And then there was the private credit event in First Brands, which hit a lot of private credit firms, not necessarily the banks. And then we've been wondering aloud where the misallocation of capital was in private credit. This one was also an auto parts supplier. But are these just kind of one-off events, or is this maybe canaries in the coal mine of much more going on? Because you wouldn't expect, with rates coming down and with financial conditions so easy, that we'd see some kind of high-profile credit events. What is your take on that right now, Blaine?
I think if you're looking at a time horizon, the answer to your question can be yes on both. They are one-off events right now as the market looks at them, but as we go further down the timeline, we might look back and say those were the canary in the coal mine. As you have on the chart here, and we've talked about, credit conditions have been easy. There have been the demand for issuance in the high yield market and the leveraged loan market has been robust. And then we all know the story that we hear about in private credit, the money that's been allocated to that space and now, trying to get the retail investor more involved in that space. That's been robust. So I think you look back on these situations and you start to wonder about what type of credit is getting underwritten. And you might look back at some point here in the next year and say those were some warning signs that some things are starting to come to the surface about what's been underwritten the last, call it 18 months. Another theme along that topic of what I've been seeing in some of the research is the amount of PIK loans in some of the private credit entities, the BDCs. Some research is saying that's north of 11% now, up a couple percentage points, I believe, from this time last year. So to me, that's another signal that while there's probably some bandwidth to allow companies to forego paying interest, capitalize that interest, it does defer interest payments within the entity itself, within the portfolio itself. But over time, if that number continues to rise, you start to have to wonder about the credit quality overall and the wherewithal to manage through that. So in asset class that's maybe one step removed and less transparent. So those are some of the things. So I think you're right to be asking those questions. But right now it's game on as usual. So.
Yeah, no, I hear you. And Blaine, maybe you can explain for the listeners who are maybe not in the weeds in the loan market or the credit market, or don't have the battle scars from 2008, what exactly PIK or payment inclined loans are, and why the increase in PIK is a kind of a negative sign.
Yeah, so it's designed to give a company that might be hitting some struggling times, maybe a quarter, 2 quarters, 3 quarters, or something like that, give them some ability to not pay the interest that's due on their loan. So what happens in that interest doesn't get paid, but it gets capitalized to the loan balance. So your loan balance continues to grow, but there's no cash outflow to pay interest. So at some point that PIK toggle either needs to get turned back off, at which case now you have a larger loan balance that you're paying interest on, or you realize this company might have more issues than just 1 or 2 or 3 quarters that they needed the flexibility to not pay that interest. And then you work with the company in other ways through amendments and things like that. We would typically see in leverage loans and maybe even high yield, you would see the rating agencies maybe come in and opine on kind of what's happening or what's going on. I don't think you're going to see that obviously in private credit. These are privately owned companies that private credit companies own the vast majority of, maybe 1, 2, 3 lenders. So they have the flexibility to allow these companies to do that. But if the percentage of their portfolio that needs to have that PIK flexibility increases, to me, that's just a little bit of a sign that companies are struggling, or for one reason or another, and it's just something that should be watched. So.
But it still seems to suggest that, like you said, it's game on. Investors are willing to do this, even with what might be lower quality companies or companies, like you said, are struggling. That investors are still willing. There's enough money sloshing around that they're willing to provide plenty of capital to these companies right now.
And that's what I meant, by that comment. So either in the new issue market, there's still plenty of demand for credit. There still seems to be plenty of money in the pipeline to help these companies to give them the runway that they might need. It's just something to watch over time, because if it doesn't get fixed, and at some point that becomes a tangible asset that's struggling, and someone, the owner of that asset's going to take that loss. So yeah.
So Tony, I want to kind of pivot a little bit, because I brought up a different screen here. This is one of my favorites, equity screens, the zombie companies within the Russell 2000.
I like it too. Yeah.
Yeah, those for who their last 12 months EBIT is less than their last 12 months interest expense. So companies that can't even make back their interest expense, the Walking Dead, if you will. But in an environment, in a market with money, with financial conditions easy, and with cost of credit coming down, what are we seeing is that in the last 3 months, this aggregate 15 or 16% of the Russell 2000 is up 18% in the last 3 months. It has been the hottest part of the market right now, the junkiest part of the market, the lowest quality part of the market, whatever factors we want to describe this as. I'm not trying to have any animosity, but these were generally what we considered a low quality. I mean, they're not the quality factor. They're the opposite of that, right? They're low quality. They're highly levered. They're high volatile names. Those factors seem to be working very, very well, especially in the small cap universe. Is this something that makes complete sense to you? And would you expect this to continue right now?
Rich, this is actually a great question to ask. This is a $1 million question. That's what actually Blaine just pointed out. This company has a very typical, very poor balance sheet with poor credit rating, meaning they have a huge problem to finance their operation in high interest rate environments. And most of the companies are defined as company with long duration. Most of them, we have no doubt, are the healthcare company and real estate companies. So we can easily spot on. However, under the low interest rate environment, this is two things activity that typically turns on. One, apparently number one will be the consolidations. Like many of the healthcare company or biotech company might become a target of acquisition. One, the cost of the capital become cheaper. And due to the liquidity, high liquidity market at this moment, now here, I would anticipate that the MMA process would continue. And if we do see like a 50 basis point cut in October and another 25 basis point cut in after, the MMA activity will accelerate. That being said, is most of the zombie company will certainly become more valuable than market anticipated, right? This is certainly no doubt long duration company in the low interest rate environment. When interest rate got cut, their actually expected return goes much, much higher. This is no surprise from statistical and from the economic point of view. And now another way to look at the market liquidity is that there were actually more and more of IPO and hot IPO recently. Even though maybe one company just was one person, like Firmic, it's like established, just set it up in 2025, just go IPO instantaneously with one person, one employee. You know, you can see this definitely look more like a 1999 and year 2000 bubble. So this is definitely is a kind of concerning to a certain extent. Well, I'm not denying it. However, we actually look at overall. I mean, this is still remain a smaller fraction of the overall market, but this is to a certain extent, Richie, you are a great market technician. If we look at IWM or like Russell Small Stock Index, apparently this is just going to actually continuously to break out and to show the interest and the support from the institution. If it's not that, we will probably might not even see this. Like we definitely see the small cap, we see huge institutional support, not purely just from the retail investor. So that's overall my observation. And as you are better than me in terms of this, but from the statistical point of view, from economic point of view, the continuation of this kind of a trend should remain intact if we see more of a major cut in this month and later after.
Yeah, I would agree. I mean, small cap value has definitely been in that style box, in that 9-box style box that people might be familiar with from looking at their 401ks, et cetera. Small cap value has been the best performing place in Q3. Still not year to date, still has a lot of room to go, but I've got the chart up of IWM, as you said. I mean, it's had a good September like everything else. It's had a really good August.
Yes.
And I think you're right that there's the trends are starting to turn higher in their scope, and honestly, there's still a really high short base among hedge funds if we look at within the commitment of traders data. So we know the first move, and typically when people want to add beta to their portfolios for that fourth quarter rally, that Santa Claus rally, is hedge funds reducing their shorts, and I think the
that might
shorts right
actually
now
add
are
more of the feel,
everyone's long large cap tech or long large cap names and short Small cap size has been the size factor. So large cap has clearly outperformed small cap this year, and then reducing shorts in small cap, it could potentially be fuel for that move higher. But that brings me to another thing I wanted to look at with you guys. It's something I've been talking about this week on LinkedIn, and I had the chart up here of the dollar index, and it's kind of on a 15-year trend line since the financial crisis, and it hasn't broken through, but it's kind of right there right now. And with interest rates coming lower, the interest rate differential support is going away. We've talked before on the Macro Matters podcast about how on a hedge basis, U.S. sovereign debt is actually the least interesting in the world when we compare it to certainly to Europe and Japan. And so the U.S. bonds aren't necessarily that attractive. We see that in the auctions. No one's really stepping up. U.S. stocks, large cap stocks, are still attractive, but we do hear from the trading desks that people that own those are hedging their dollar exposure, the global investors, that is. And so there's a little bit less optimism, certainly, about the dollar. And if we were to break through this level, we could potentially see, maybe the incremental marginal dollar that gets invested, maybe looking for other places. I don't know if that's small cap in the U.S. or more likely it's into emerging markets, and because there's always been a negative correlation between the dollar and emerging markets' relative performance. And along those lines, Tony, I mean, we know this Chinese central bank's been lowering rates. We hear about the fiscal stimulus about to pick up, but more importantly, the AI theme that's been driving the U.S. might be actually certainly less valued, but maybe underappreciated when we look into Chinese stocks. Is the marginal dollars, is the dollar weakness here potentially a catalyst for investors to think about looking at AI within China?
Oh, certainly. Just no doubt about that. And we continuously talk about this, and we actually remind the investor to really look at the stock market in the emerging market, or including the Asia, China, Hong Kong Stock Exchange. And Hong Kong Stock Exchange remain to be one of the best performing market this year overall. With the weaker dollar, we would anticipate that the capital, like not just from the United States, but the capital from Europe, the South Asia, Latin America, they will think about that. How would they actually allocate it for the risk and diversification perspective? Now, the still very nice place to actually look into is the Chinese stock market and Hong Kong Stock Exchange. And for all of the national security reasons over the past couple of years, I think the firm in the United States have been advised actually not to invest into the Chinese stock market for political reasons. But now here, for the rest of the world, like Europe and South Asia and Middle East, and they do not actually have such kind of a constraint or advice. So for them, they definitely need to diversify. When they actually diversify, this Chinese stock market, Hong Kong Stock Exchange is definitely a great place to go. If we actually look at what happened last year in September, when U.S. actually unprecedentedly the Federal Reserve cut a 50 basis point, and the Hong Kong Stock Exchange and Chinese stock market just hit the stop the clock, which means the whole index hit the 10% or 15%, like the rate stop over there, and investor will continue to look for similar things happen. If in October this month we saw another 50 basis point cut, so you can imagine investor would actually flee similarly what we have seen in the last year into the Hong Kong Stock Exchange. That's why, given an iPhone, even both the return reward and risk ratio, and also the risk and diversification perspective, have given an eye over there is definitely quite worthy. And with the weaker dollar, and the weaker dollar would help the U.S. economy, U.S. exporter to remain strong, because this is aligned with the national strategy to bring these manufacturing act into the United States. A lot of people questioned, it's like we haven't really seen the manufacturing job coming in, and manufacturing hasn't really come back. But if we actually do want to bring the manufacturing back, we prefer the whole market environment, prefer the weaker dollar because the product would look cheaper, right? You don't want to sell goods with like a strong US dollar currency, and that was a strategy that China utilized before. So pretty much what we are trying to imitate it was the successful strategy that Chinese government had been doing over the past 20 or 25 years. It's like national like a state capitalism, whether we like it or not. So we don't call it, but it's just state capitalism. So in a sense, yes, think about risk diversification and also portfolio allocation. Still keep an eye in like East Asia over there.
Yeah, you know, that's definitely been something, like I said, I talk about. I have the chart up right now of that dollar index inverted versus the outperformance of China versus US. And you could see China, emerging markets, even the rest of the world has a lot more upside to go. I think, and to the standpoint that people still will look at me side-eyed when I suggest that to them. It says, you know, it used to be China was uninvestable. I think that's tone has softened quite a bit, and now people might be a little bit more willing. And if there's any sort of trade deal, you know, between U.S. and China here in the coming weeks, that might be a catalyst. So that should be something that is definitely on people's radars right now.
Yeah, at least like a presidency has invited formally invited President Trump to visit China next year, and he invited to visit the September 3rd victory parade early this year. But more likely to happen that if President Trump decided to actually accept the invitation to visit China early next year, that's actually would help the investor to be more open to the like a Chinese stock market over there, and we do. And to be honest, like this will be beneficiary for economy for both country and for the rest of the world, because China so far has the historical recession over there, which means deflationary. You see a huge high deflationary factors over there. And in the United States, we see historically high inflation over there. So it's nothing but you just merge these two together. This is all gone, you know. So yeah, this is definitely. I think President Trump see the economic benefit here. However, how well that both countries can actually resolve from the political disagreement and some other area like national security, that's remain unknown. However, the settlement for the TikTok actually set a very good indicator that at least President Trump is actually willing to maybe get some kind of agreement with President Xi. So that's the point. Coming back to you, Rich.
Yeah, I think there are probably people would like to see President Xi buy some soybeans too, because the U.S. farmers are struggling right now because of lack of Chinese demand, and soybean prices are well below
Yes.
production costs, which means that that's another part of the economy, and the farmers are struggling.
Very
They're
true.
they're losing money right now, and so that's another weak part of the economy. I don't know if 50 basis points cut's going to matter to them or not, Tony, because they're already losing
Yeah,
money.
probably not. Yeah.
But Blaine, I wanted to maybe kind of get your thoughts here. I mean, we're talking about, you know, maybe some potential posits that are. I just have like, this is just a graph of credit spreads up, and this is the Moody's BAA, et cetera. You know, in this backdrop, is there any, you know, we're not at the lowest levels. We're not even at the lowest levels we saw last year, but in an environment where you know, we might be seeing more rate cuts going forward as much as the market thinks. Should we expect these credit spreads to kind of go back to where they were in 2024, where they were in 2005 and 6? You were talking about PIK before. We're talking about financial crisis, but you know, those types of things were happening back in 2005 and 6, and you know, we could still see spreads tighten quite a bit, it would seem, from here, which would certainly be supportive for other risk assets. But is that somewhere where people should be thinking?
Yeah, I'm not on that particular train or bus yet. I think, given we talked about the money that's sitting on the sidelines. Tony was talking a little bit earlier about the M&A activity, and we've heard about that. All year was supposed to pick up. So there's money out there on the sidelines looking for deals, looking for transactions. Credit is still available. I would think you could see this chart continue to tighten up. I don't think that I've hearing or seeing anything that looks like a blowout, like we've seen, in the other parts of this chart back in 2006 and 7 and 8 and 9 and 2000, or 2020 and 2021. So, I'm not going to be the procrastinator of that type of bad news. I think the one thing that kind of stands out to me just is, I've been involved in certain similar situations in the past, is just the amount of money that's being thrown at some of this infrastructure build out and some of this data center build out. I started my career in leverage loans in the early 2000s, call it, and remember the amount of money that was being allocated and put to companies to build out internet cable and spectrum and things of that nature, on the idea that if you build it, they will come. And there was just this overbuild that happened, and eventually, you needed some of that, right? But you just didn't need all of it. And some of those companies obviously aren't around any longer. So I think that's just one area of the market that I'm kind of looking at, going, I've kind of seen a similar story before. That is not to say that we don't need to build out for AI. We certainly do. And that is, you're not going to put that genie back in the bottle, but there just seems to be a lot of just, it's all good and there's no breaks. And just, that type of talk just, is a bit of a yellow flag for me, I would say.
Yeah,
Yeah, I looked at a stock this week with students that was basically the roll up of the old L3 communications as well. And I'm like, and
Yeah.
all the fiber optic, and that kind of brought back memories of what you're talking about.
Yeah.
I was actually kind of referring to something different, not that the credit spreads were going to blow out wider, but that actually there's maybe more scope for them to tighten. And we
Yeah.
did see some pretty major activity. It wasn't necessarily, we had the biggest LBO in history, right, with that EA this week.
Yeah.
And so that was quite a bit of credit provided to the market. And I think we also saw some of that cash on the sidelines. Berkshire didn't buy all of Occidental Petroleum like a lot of people were thinking or hoping, but at least bought $10 billion worth of their chemical units. So some of that money is definitely coming off the sidelines, going to work right now. And it would seem like potentially there could be scope for more of that. And that I think that's kind of an interesting point here.
Sorry. I completely agree with that, Rich. I kind of went the opposite way with your question.
Yeah.
I completely agree. I think there's plenty of money right now. There's still a need for like I said, credit. People want yield in their portfolio, and they're gonna continue to look for it in deals that are out there are going to get done. So I think there's still a demand for it in that respect. So you could see some tightening here. Yes.
And another implication of the potentially weaker dollar, Tony, is crypto, right? We
yes.
started to see some weakness, but here looking at the crypto screen, Bitcoin is going back to all-time highs again.
Yes.
Ethereum and Solana that had kind of sold off, kind of hit some support and have bounced. So it seems like we're kind of back to risk on in the crypto space. Certainly risk on in gold and silver. The dollar alternatives, not just among other foreign currencies, but in whether it be precious metals or crypto, seem to be the place that investors are preferring right now. And anything that stands out to you in the crypto space, Tony?
Richie pretty much cover most of them, all if not all of them. And apparently, when the dollar getting weaker and the national debt here reached to historical high, and like a two-party cannot make an agreement or make a deal to reopen the government, the risk appetite for this kind of alternative, like national treasury, the federal treasury, is going crazy as what we see here right now. the Bitcoin come back historical high, similarly for gold, reaching to historical, I think going to be getting crazier. And if we actually look at this is how things, anything that could actually stop like the alternative to federal treasury from going higher, it's one way is that two party might actually really sitting down and make agreement to reduce the budget deficits and simultaneously reduce the federal spending, right? And the answer for both of them are probably a negative, right? No one would actually want to sit down and show weakness before the midterm election in 2026. And no one is willing to actually cut the government spending because that basically saying that more layoff and simultaneously like a tightening, weaker economy. No one want to actually see that, especially President Trump, who actually behind all of the bull market in the crypto and also the stock market. So it's like so here we have a very market favor and market supported administration looking at the market on a daily basis. Like both of them, the Secretary of Commerce and also President Trump are watching the stock market on a daily basis. When you have a president administration like that, it's actually quite difficult actually to imagine that the dollar can get actually stronger. That being said, is just like the demand for the alternative actually getting weaker. This is a kind of I just do not see the catalyst for this to come into reality to actually stop this from going higher. I mean, not because of the fundamental value, but because they were treated as an alternative.
Yeah, no,
The
for
federal
sure.
treasury, yeah.
Yeah. And you bring up a good point because that was something that I was asked in my class this week when we are talking about what was in the headlines and a lot of people were focused on the government shutdown and my maybe cynical response to them was that it really just doesn't matter because this is just a political dog and pony show and there's not anything
Correct.
really meaningful going on there. But again, I'm jaded and bitter. Blaine, you're much more upbeat than I am. When you think of the government shutdown, is there anything for investors to worry about, at least right now? I mean, of course, things will play out as we don't know how they're going to play out, but right now, is this a big potential risk factor on your screen or not?
Not at the moment. Longer it goes on, you always have to ask yourself, where are the implications then? But you're seeing the headlines about certain projects that are, funding's being withheld now, and the left side of the aisle wants the ACA monies to not roll off. I guess that would be one thing from a fiscal standpoint, that if you said, well, you can argue whether that's good or bad. But from a monetary standpoint, if it increases the deficit, things of that nature could maybe have an impact on just the outlook for yields if they get their way in this holdout. But yeah, right now I market's kind of yawning at it, and I think that's kind of how I feel. If it goes on a couple of weeks, then maybe it's maybe a little more something. I mean, we're not getting our economic numbers, so as you said
Yeah,
earlier, maybe that's
true.
good or bad. I don't know.
Things can't move if you keep the screens turned off. I would say, I mean, Tony, you mentioned, kind of if both sides
Yes.
could actually agree to maybe cut some spending. I think to me that you could make for a bullish case here if actually this shutdown led to some fiscal restraint. I
Yes.
think most of us would agree that that's most likely not going to happen. But going back to the first quarter of this year, it seems like it was so long ago. So much has gone on since then. But I think for myself and a lot of people, the whole idea of Doge was a really bullish idea of cutting spending where there's maybe kind of fraud and waste. Maybe the execution wasn't quite what people were thinking of. But when we look back to that, you look at there were some, the sectors that were doing the best in the first quarter of this year. Is that if we do start to see some, some real efforts towards spending cuts, is that something we should be looking for, a replay of Q1 here in Q4, or is that too optimistic? We might have lost Tony for a second. Blaine, what do you think?
Yeah. Yeah, I think as far as it relates to spending cuts and even these, I guess the president's going to call them firings and not temporary layoffs.
Yeah.
Yeah, I think, again, all that down the line, the longer this goes on could, obviously impact, for instance, the job numbers. And I mean, back to our earlier conversation about what the Fed is looking at, and all these moving pieces, at some point that stuff starts to matter. So you cut out the government spending, but you create more people that are now looking for jobs. And is it the fat we're cutting, or is it fraud, or what is it that we're actually getting to? I think your point on execution a few minutes ago was I kind of come down on it. I'm not sure that it was executed all that well, but time will tell.
Yeah, for sure. And I think one of the things you mentioned, some healthcare, et cetera. I mean, that would have been one of the worst performing sectors because of the the pressure the administration been putting on those stocks. But with the talk of a Pfizer deal, it's almost kind of like the discussions around tariffs. Once there's rumors of some deal that presumably provides a template for others to have a deal, there's a big kind of relief rally. And so we've definitely seen that with healthcare being the best performing sector outside of the AI exposed stocks here in the last month or so. So maybe sometimes it's not even the presence of light, it's just the absence of darkness. And then we've seen that certainly all year, where the non-negatives become big positive catalysts. And so maybe, Tony, I'll give you the last words on your thoughts on government shutdowns and how investors should be thinking about that here into the end of the year.
Yes, as what we actually have discussed, we do not anticipate to see the huge impact of the government shutdown over the stock market at this moment, because due to mainly the political issue. By looking at the different sectors, apparently IT, due to the capex on AI, has already driven also the performance and also the productivity enhancements, like for Magnificent Seven, drive up the revenue growth. This is something that we have already seen. Now here, given the recent advancement of AI, especially the Sora 2 from the OpenAI, we might continue to see the demand for data center and demand for energy storage will pick up nicely. Because in the past, when we actually dealing with texture base of the Chat GPT, it's mainly the text base. The demand for the computational power might not grow exponentially, but now here we actually are dealing with the video generation like a Sora. So the demand for either the computational power, energy, electricity, storage will grow up exponentially, and this hasn't been fully appreciated by the market at this moment, still at the early phase, and that might be the high demand for electricity definitely might drive higher inflation. This is to a certain extent basically means all of us might have to pay for high electricity bill, utility bill on a monthly basis. But hopefully the replacement impact of AI has might slow down, which might be just a certainly good wish. But being said is that the advancement of AI is ongoing, on fire. And this is one actually great, super interesting example. The ticket called OPEN. And a lot of investors, retail investors, thought and think it's OpenAI. They actually try out, but it's actually it's open door technology, and people think it's OpenAI to buy it. So you can see there's a lot of liquidity, a lot of the greedy sentiment flooding over the market. I mean, to a certain extent, it's actually very concerning. If you look at this, this is definitely 10 back. People I just it really remind me when we actually started finance. Like remember in the past when we started about the 3Com and the communication device. Like people thinking the 3Com it's also the ticker for 3Com companies. But my final thing is a good way to think about this. We do actually start to see some concerning bubbling effect of AI. Investing into the AI actually might actually should remain to be cautious at this one moment, especially at the end of the year. But the tailwind behind the market rally remained there. The corporate tax cut and lower interest rate and stronger global national economy remained intact. So this would all help to make the current market valuation high. So that's my final word. Coming back to you, Rich.
Okay,
Blaine?
yeah. I mean, there's, Tony makes the case for 50 basis points the whole podcast, and then he says it's a bubble in AI. So that doesn't seem to me like that's a case for 50 basis points, Blaine. But I'll give you the last word, and then we'll wrap it up.
Yeah, I think my take. I think the Fed will stand pat at 25. I think we'll get the 25. I think the drum beat will certainly be for 50. I'm not sure the case is there for it yet, but we might get a total of 75 before the end of the year. We'll just have to wait and see. And I think Tony's point on the electricity, it's something we haven't really talked about too much on this podcast. Maybe we can get to it at another one, but that is throughout the year you hear about data centers, but the one thing that you hear about as much, if not more, is the electricity and the need, power need to build that out. So it's worth paying attention to as well. So.
It is, and perhaps in a couple of weeks we can come back and talk about data centers, utilities, electricity prices.
Yeah.
We had the Fermi IPO coming out this week, which was a big one. We see uranium prices going through the roof, and so
That's what I was referring to. Just one employee, one established in the year 2025, one less than 1 year going IPO. This is kind of crazy.
it certainly is, and I can't wait when all the consumers have no jobs because of AI, then they get their electricity bill, and it's going to be a lot higher. That's going to be fun times.
Yes.
Blaine, Tony, thanks again for joining us. We look forward to kind of catching back up with you in a couple of weeks to see how the early parts of fourth quarter are playing out.
Looking forward to it.
Yeah,
Thanks,
me too.
thanks,
It's
Tony.
like enjoy the rest of the summer.
Thanks, everyone.
Yeah, thank you.